On the 11th of November, 2022, a Bahamas-based crypto exchange called FTX filed for bankruptcy. The story made global news for a long list of reasons. $8 billion in customer money missing. A young founder named Sam Bankman-Fried under federal investigation. A celebrity-studded board collapsing in a single weekend. On the 7th floor of a small office building in downtown San Francisco, an African engineer named Ham Serunjogi opened a different headline on his phone. 1 year earlier, FTX had led a $150 million funding round into Ham's company. The round had valued his company, Chipper Cash, at $2.2 billion. It had made Chipper Africa's 7th unicorn. It had put Jeff Bezos, Silicon Valley Bank, Ribbit Capital, and the most famous name in crypto on the same cap table. Now the most famous name in crypto was in bankruptcy court. Two friends from a small college in Iowa had built a company worth more than $2 billion in less than 3 years. In a single weekend, the company they had built was about to be cut in half. The thing they had been told would save them was the very thing that was about to nearly kill them. This is the story of Chipper Cash, the Pan-African remittance company that rode the cheapest capital in the history of African fintech to the top, and then had to teach itself how to walk on its own legs. This is Asili Africa. Hi again, welcome back to the pod. My name is Farouk, and today we are going deep into the story of Chipper Cash. The story of two African students from a small college in Iowa who set out to make sending money across African borders as easy as a text message. Rode the pandemic fintech boom from a $30,000 founder's grub stake to a $2.2 billion valuation in less than 3 years. Lost more than half of that valuation in a single weekend when their biggest investor went bankrupt, and spent the next 3 years stripping the company back down to what they should have been building all along. Let's get into it. Ham Serunjogi was born in Gaba, a suburb of Kampala, Uganda. He grew up swimming. By his late teens, he was a competitive freestyle swimmer, racing for Uganda in regional meets. The swimming, more than the grades, was what carried him out of the country. In 2012, he arrived at Grinnell College, a small liberal arts school of about 1,700 students set on a quiet corner of Iowa. He came on a swimming scholarship. He chose to study economics. That same autumn, on a different part of the same campus, a Ghanaian computer science student named Majid Mujaled was beginning his own degree. The two of them met, almost inevitably, at the small overlap on Grinnell's campus where international students gathered. Two Africans in a small college in Iowa in the middle of an American winter. They became friends. They graduated separately into the Bay Area job market. Ham went to Facebook. He worked in growth and product roles, then briefly at a Y Combinator-backed wedding startup called Zola. Majid went to Flickr and then to Yahoo as a software engineer. They saw each other when they could. They shared the unspoken understanding of two African graduates who'd spent the previous 4 years explaining to American classmates where their countries were on a map. In the summer of 2016, the two of them took a road trip together. The exact route does not matter. The conversation does. Ham had recently tried to send money to his father in Uganda from his Facebook salary in California. The transfer had been slow. The fees had been steep. There were intermediaries he had never heard of taking a percentage at every leg of the journey. He was, by every reasonable measure, an upper-middle-class Bay Area engineer, and he was being charged close to 10% to send a few $100s to his own father. The math made no sense to him. The friction made no sense to him. He kept asking, in the way that engineers ask, why? By the end of the road trip, they had a single line on paper. They wanted to make sending money across Africa as easy as a text message. They went back to their jobs. They sat on the idea for almost 2 years. In the spring of 2018, Ham sent Majid a message. He said it was time. Ham quit his job at Facebook. He packed what he owned into a single bag. He moved into Majid's studio apartment in San Francisco. There was no spare room. He slept on an air mattress in the kitchenette. They lived off Majid's salary at Flickr and about $30,000 in combined savings. Patrick Trieste, an American software engineer who had worked at Google, joined the founding team as the technical lead. 3 people in one studio, 1 air mattress, 1 thesis. In July of 2018, the 3 of them launched a test product. It moved money between Uganda and Ghana in local currency on a phone number with no fee. The competitors charged 8 to 10% on a small African remittance. The new product charged at 0. The plan was to make the money on the foreign exchange spread underneath, and on whatever venture capital they could raise to subsidize the early years. The pitch was a single sentence. Venmo for Africa. 3 founders, 2 African and 1 American, in a kitchenette in San Francisco, with $30,000 in the bank and a working product that moved money between 2 African countries. That was the company. The first product worked. The second problem was harder. The product needed money. The market in San Francisco that handed out money to startups did not, in 2018, have a coherent picture of African fintech. Ham, Majid and Patrick pitched more than 50 venture capital firms. Most of them said no. Many of them said no without taking the meeting. Many more said no after taking the meeting. The reasons were variations on the same theme. The market was too small. The regulators were too complicated. The founders were too young. The competition was too entrenched. The unit economics were not yet proven. Ham has said, in interviews since, that the deeper reason was simpler. The Bay Area venture capital industry at that point had funded almost no African founders for African problems. The pattern recognition that venture capitalists rely on almost always rewards a founder who looks like a founder they have already funded. 2 African graduates pitching a free money transfer product into a market. Most American investors could not name 3 banks and did not fit the pattern. In November of 2018, after months of those no replies, the founders got 1 yes. A Bay Area accelerator and seed fund called 500 Startups put $150,000 into the company. It was the first institutional check. It was also enough to extend runway by a few months. Through the back end of 2018 and into 2019, the company began the unglamorous work of expanding corridors. Each new market meant a new regulator: the Central Bank of Nigeria, the Bank of Ghana, the Central Bank of Kenya, the Bank of Uganda, the South African Financial Sector Conduct Authority, each one with its own licensing regime, its own know your customer expectations, its own forms, its own waiting times. Each new corridor also meant a separate negotiation with the banks and mobile money operators who actually moved the money on the ground. M-Pesa in Kenya, MTN mobile money across multiple markets, Airtel money in Uganda and Tanzania. Each integration was a contract. Each contract was a quarter of work. By the middle of 2019, the company was live in Kenya, Tanzania, and Rwanda. Volume was small. Unit economics were carried by a thin foreign exchange spread and a thinner venture subsidy, but the network was real and it was growing in the only way an African fintech can really grow, one regulator at a time. The first publicly disclosed funding round closed quietly in May of 2019. Then, the world changed. In March of 2020, the coronavirus pandemic shut down most of the global economy. Airports closed. Western Union queues evaporated. Money transfer agents pulled down their shutters. Diaspora workers, who had been sending cash home through informal channels for decades, suddenly had no informal channels to use. Chipper was an app on a phone. It worked. In June of 2020, Daciens Capital led a $13.8 million Series A round into the company. Raptor Group joined. The lockdowns kept lengthening. Chipper kept growing. Later that year, the company quietly launched in Nigeria, integrated Bitcoin trading, and prepared to raise again. The first phase of the company was over. The bootstrapped, polite, slow building phase. The phase where every corridor had to be earned. Every regulator had to be cultivated. Every dollar of capital had to be argued for. The second phase was about to begin. And the second phase was going to be funded by a kind of money the African continent had never been offered before. The capital that flooded into early-stage technology between the summer of 2020 and the end of 2021 was, in retrospect, an aberration. Interest rates were close to zero. Pandemic stimulus had pushed liquidity into every asset class with a story. Software multiples touched levels they had never touched before. African fintech, for the first time in its short history, became part of that story. Chipper rode the wave. In November of 2020, the company closed a $30 million Series B. The round was led by Ribbit Capital, the U.S. fintech specialist firm. Alongside Ribbit, a name appeared that no African startup had carried before. Bezos Expeditions, the family office of Amazon founder Jeff Bezos, wrote its first-ever check into an African company. That single piece of news rewrote the conversation around Chipper. Inside Bay Area venture capital, the pattern recognition flipped. African fintech was now investable. Two African founders in a San Francisco studio apartment had pulled the most famous balance sheet on earth onto their cap table. In May of 2021, the company closed a $100 million Series C. The round was led by SVB Capital, the investment arm of Silicon Valley Bank. Bezos re-upped. Descience, Ribbit, One Way Ventures, Tribe Capital, and 500 startups all wrote alongside. The valuation crossed $1 billion for the first time. Ham publicly described Chipper as Africa's most valuable startup. 6 months later, the round was extended. In November of 2021, an additional $150 million came into the company. The lead was a Bahamas-based crypto exchange called FTX through its trading arm Alameda Research. SVB re-upped, Ribbit re-upped, Bezos re-upped. The valuation came in between $2 billion and $2.2 billion. Chipper Cash was now Africa's 7th unicorn. The strategy widened with the funding. The original product was a free Pan-African remittance app. By the end of 2021, the company had layered on Bitcoin and Ethereum trading, then U.S. stock investing with fractional shares of more than 6,000 U.S.-listed equities on a 1% commission, then a Visa-branded virtual debit card, then a U.S. dollar card. The Lagos engineer with a Chipper account in 2021 had, on a single phone, a wallet, a brokerage, a crypto exchange, and a debit card. The thesis was no longer remittance. The thesis was an African super app. The capital agreed. The product surface kept expanding. The headcount climbed past 400. Lagos, Nairobi, Kampala, Accra, Johannesburg, and London all had Chipper offices. The two founders, who had once slept on an air mattress in a kitchenette, were now running an Africa-wide consumer financial platform from a downtown San Francisco office, with Jeff Bezos and the most famous balance sheet in crypto on the cap table. Then, in July of 2022, the first warning shot landed. On the 28th of July, 2022, the Central Bank of Kenya publicly named Chipper Cash, along with Flutterwave, as operating in Kenya without remittance and payment licenses. Within days, the bank supervision arm of the CBK ordered all Kenyan banks to cease and desist from dealing with the two companies. The hit was reputational rather than operational. Chipper kept moving. The Kenyan corridor was one of its largest. Within the company, executives spent the next 18 months working through licensing remediation with the regulator. Within the press, the headline stuck. A unicorn had been publicly told it was operating outside the perimeter of the law. 3.5 months later, on the 11th of November, 2022, FTX filed for bankruptcy. The collapse of FTX was a global story. For Chipper, it was a local one. The largest single investor in the company's last funding round was now insolvent. Within weeks, Financial Times reporters working through leaked Alameda Research documents found a line item. Alameda had, before its own collapse, internally marked its Chipper Cash position down from $2 billion to $1.25 billion. The valuation was, on paper, slashed by $750 million in a single news cycle. Ham's public defense was technically correct and unhelpful. Chipper had received cash, not FTX tokens. The capital was already in the bank. The company had no operational exposure to FTX. The relationship had been passive, but the optics were absolute. African fintech's most prominent unicorn was now the African company most associated with the largest crypto fraud in history. On the 6th of December, 2022, Chipper announced its first round of layoffs. About 12.5% of staff, somewhere north of 50 people, left the company. The second round came less than 3 months later. In February of 2023, the company cut between 33 and 40% of remaining headcount in the range of 140 employees. In the same window, the C-suite emptied. The Chief Operating Officer, Alicia Levine, left. The Chief Information Officer left. The Chief Revenue Officer left. The Chief Compliance Officer left. The Global Head of Marketing left. The Kenya Country Director, Leon Kiptum, departed. In the same month, the UK-based diaspora remittance company ZEPS, formerly World Remit, approached Chipper with an acquisition offer. The proposed price was between $250 million and $500 million US. It was a discount of roughly 70 to 80% on the $2.2 billion peak. Then, on the 10th of March, 2023, Silicon Valley Bank failed and was placed into receivership. Chipper's deposit exposure to the bank itself was about $1 million US, a small fraction of the balance sheet. The bigger problem was symbolic. SVB Capital, the investment arm, was the lead investor on the Series C that had taken Chipper to unicorn status. Within 5 months, 2 of the company's most prominent backers had collapsed. African fintech's most prominent unicorn was now also the African company most associated with the second-largest bank failure in U.S. history. Through the middle of 2023, the ZEPS acquisition went into due diligence. The 2 companies could not agree on what the financial picture inside Chipper actually was. ZEPS later said that what it saw during diligence raised viability concerns. Ham later said that ZEPS had refused to share its own books. In August of 2023, the talks collapsed. Each side blamed the other. The public anchor for Chipper's fair value was now well below $500 million US. A third round of layoffs followed in June. A fourth round of about 15 employees followed in December. Each round was smaller than the last. Each round was in a quiet way more damaging than the last. The thesis had not changed. The product still worked. The corridors still moved money. The fundamental insight that 2 African founders had named in a rented car in 2016 was still correct. The funding base that had built the company had simply gone away. The company that walked out of 2023 was about half the company that had walked into 2022. The boardroom in San Francisco was leaner. The product roadmap was shorter. The growth story was, for the first time in 3 years, secondary. The strategy reset around a single thesis. Chipper would be a cross-border remittance specialist. The card product would scale on the back of the remittance flow. The crypto trading product, which had collapsed alongside the global crypto market, would be quietly deprioritized. Stock investing would continue. New geographies would wait. In November of 2023, Chipper expanded its partnership with Visa. Over the next year, the company crossed 1 million virtual cards issued. By the end of 2024, Chipper was, by Visa's own count, the largest virtual card issuer in Africa. On the 27th of March, 2025, the company announced a partnership with Ripple Payments. The deal added XRP-settled cross-border rails to Chipper's diaspora to Africa flows. The crypto story had been rewritten. No longer a retail trading product, now a wholesale settlement rail. The Nigerian naira fell roughly 70% against the US dollar between 2022 and 2025. The foreign exchange margins on Chipper's largest corridor compressed brutally. The company offset the compression with volume. Slow, unglamorous, corridor by corridor. In the fourth quarter of 2025, Chipper Cash posted its first ever quarter of positive free cash flow. On the 21st of January, 2026, Tech Cabal published the headline that codified the turnaround. Chipper Cash posts first quarter without cash burn. The company is still privately held. The cap table still carries the $1.25 billion US mark from the FTX era. FTX's stake itself is now a bankruptcy claim, administered by the FTX estate for the benefit of FTX's creditors. The valuation overhang has not gone away. No new primary round has tested the public market's appetite. The exit path is narrower than it once was. The obvious strategic acquirer, Zeps, walked away in 2023. An initial public offering at a meaningful valuation is years out, if it comes at all. The competitive landscape is more crowded than it was at founding. Lemfi, Nala, Sendwave, Wise, Zeps itself, and the mobile money operators all compete for the same diaspora flow. What Chipper has, in 2026, is the rarest thing in African fintech. A profitable cross-border remittance business with real customers, real corridors, and a real balance sheet. The company that survived is, in almost every way, less interesting to the venture capital ecosystem that minted it. It is, in a way, the founders may now agree with what they should have been building all along. The story of Chipper Cash is the story of two friends from a small college in Iowa who set out to make sending money across African borders as easy as a text message. The cheap capital that built them tried to take them with it on the way out. They walked back into the original sentence on the original road trip. The company that survived is the one they would have built without the rocket. Every empire has an origin. This one began with an air mattress in a kitchenette in San Francisco. This is Asili, Africa. Every empire has an origin. That is the story. And like every story worth telling, this one is still being written. If this episode made you see something differently, share it with someone who needs to hear it. I am Farouk. This is Asili Africa. Every empire has an origin. Now you know this one. So start building, because yours might be tomorrow's origin story. See you on the next one.